So, sir, thank you for joining this interview with me today. To
Thank you,
start,
Renesha.
thank you. To start, as the tax department now automatically tracks bank account interest, stock sales, and credit card spends through the annual information systems. So, as a CA, does this high level of automatic tracking make filing easier for you, or does it cause extra stress over the minor mismatches?
All right. So I think talking about the annual information statement that you would hear right now, emerging and trending and all. So it has been, in my experience, you'll find a lot of your incomes getting automatically reflected in that particular form. So in my experience, it has genuinely been transformative in some respects and actually a source of real friction in others. And I think
Yeah.
an honest answer has to be that, something like which holds both truths simultaneously. On the positive side, I would say, if you look at Section 510 of the Income Tax Act 25, which is the new Income Tax Act,
Yes.
it mandates the upload of the AIS data, which has all the TDS, TCS, all the specified financial transactions, all the tax details directly into a taxpayer's registered electronic account.
Okay.
I think the practical benefit is real because bank interest that might previously have been inadvertently omitted is now pre-populated. Securities transactions reported by depositories and RTAs appear in the statement, and obviously the pre-filled return has become meaningfully more and more accurate for a salaried taxpayer, right?
Okay.
With obviously all the straightforward investments reflecting. Also, the CBDT's e-verification scheme has also now provided a structured mechanism where wherever the AIS data is appearing incorrect, the taxpayer can submit the feedback online. The
Oh,
department will contact the reporting entity within maybe roughly 3 to 4 months, and if the mismatch remains, there is a notice under Section 133, subsection 6, which follows via the compliance portal. But I agree, I think the friction, however, is genuine and should not be minimized. Minor errors are common. I think a fixed deposit interest figure may be reported on accrual basis by a bank, while the taxpayer would use a receipt basis. A mutual fund redemption may appear at the gross transaction value rather than the gain, I would say. So, I mean,
okay.
also a credit card spend may appear as a specified financial transaction, which would look alarming, but it is perfectly explained. So, all these mismatches, require the taxpayer to engage with the feedback mechanism and track the resolution, and if unresolved, I think respond to a formal notice, which is obviously a disproportionate burden for someone who has done nothing wrong. So my overall view is that AIS is a net positive for tax compliance and for honest taxpayers, obviously in the long run. But the current mismatch resolution process needs to be faster and more transparent.
All right.
So I think that is all. That is something I would like to say.
Okay, that was very clear from your end. So my second question to you would be, since many professionals invest in mutual funds or stocks, do you think the current capital gains tax rates on property and shares encourage people to invest, or do they feel like too heavy a tax burden on personal savings? What would you say?
Oh, good question. That's a good question. So I would say, see, capital gains taxation in India, has underwent a significant structural overhaul. Specifically, if I can recall the date correctly, around 22nd or 23rd of July 24, and it formed balanced views. So I mean,
Okay.
again, here we need to see both sides as well. So on equities, if I talk about, so short-term capital gains on listed securities is governed by Section 111A, and it now attracts a tax rate of 20%, which was
Oh,
15% earlier.
oh,
And long-term capital gains under Section 112A on equities, it is taxed at 12.5%, above an exemption threshold of obviously 1.25 lakhs per year, right? So on immovable property, again, Section 112 is there. So LTCG is again taxed at 12.5%, but the indexation benefit that used to be provided has now been removed for properties which have been acquired on or after that particular date, 22nd or 23rd of July, with the
okay.
transitional protection preserved for properties acquired before that date. So if it's before that particular date, then the indexation is allowed. Now, the case
Oh,
for these rates being reasonable is that 12.5% LTCG on equity, even with the enhanced rate and reduced exemption threshold, remains internationally competitive and preserves the long term wealth creation proposition for patient investors, I would say. Again, the 1.25 lakh annual exemption that is given on equity, it still shelters modest retail gains entirely. The concern, I think, if I have to highlight it that way, is real. I mean, removing the indexation on property without a compensating rate reduction means actually a genuine erosion of after tax real return on the long held property. particularly in periods when there would be elevated inflation. So for
Mm-hmm.
equity short-term capital gains, the jump from 15% to 20% would, make short horizon trading. I mean, trading within a very short period of time noticeably very
Yeah.
expensive. People would not do that. On balance, I think I believe the intent is to nudge investors towards longer holding periods so that people actually
Mm-hmm.
don't, sell and have a higher rate of tax, and away from a speculative churn, which a lot of people say that it's bad, you should not do speculation. It's a sound policy, but the property indexation removal, I think, deserves more scrutiny, especially for middle class families whose
Yes.
primary wealth is locked in something like a real estate, more so like a concentrated asset single position. So I think that is something, I mean, I would want to say.
Okay. So, talking about the middle class families, with rising living costs and income increases often push professional into higher tax as we discussed. So, without increasing their purchasing power, actually, right? So, what is one simple change you would make to tax slabs to help middle class taxpayers?
Interesting. I think if I could recommend one structural change which comes to my mind, it can be completely hypothetical. It would be the automatic annual indexation of tax slab thresholds to the consumer price index. Specifically, I think linking the slab boundaries under the new regime to inflation, so that whenever a taxpayer whose salary increases merely to keep pace with the cost of living does not silently slide into a higher tax bracket. So I think I
Okay.
want to be fair when I say this. The new regime has already made meaningful progress. The nil tax threshold, effectively, would have heard 12.75 lakh for salaried individuals, there's no tax. Then the
Yeah.
20% slab covering income between 12 to 16 lakhs, the 30% rate on above 24 lakh. This represents a genuine widening from the earlier regime structure. So it's become more widened, I would say.
Mm-hmm.
But again, the snap thresholds remain static between budget announcements, and in an environment where the inflation averages 5 to 6% annually, if I am getting the figure correctly, a salaried professional's real purchasing power may stagnate, even as their nominal income and therefore their marginal tax rate rises. Now, inflation indexing, which I'm suggesting, it is already practiced in certain jurisdictions like Canada and Australia, and this would
Okay.
also ensure that slab thresholds are updated by a transparent formula each year without actually requiring a legislative or a budget announcement. It would also eliminate the optics of maybe tax relief being presented as a gift rather than simply a maintenance of the status quo. And it would also
Yes.
be administratively very straightforward to implement this. And this would also provide the middle class with meaningful and durable protection against the bracket creep, which is, in my view, a far more honest and sustainable reform than any ad hoc slab revision which has been
Mm-hmm.
happening throughout.
Yes.